Hello, everyone. Hope you're all doing well. We're now sitting on middle of April. The war has been going on for over 6 weeks. Not sure how it's going to end and what the long-term implications of this are. But I think some things are clear. There are going to be long-term implications. I am worried about, of course, some of the destruction of some of the oil and gas facilities. It's not clear to me whether the Qataris are being political about how much time they expect it to take for repairs, or they're being truthful. There's talk about the force majeure being extended. There's obviously a lot of money at stake. Um, and there's oil and gas, upstream oil and gas facilities that are also being impacted on both sides. But I think for the world markets, it's stuff on the GCC side that's going to have the most implications. There is a question about the demand destruction. We have seen countries around the world do what they have to do. We have seen the restart of a lot of coal-fired power stations. We have seen the start of using furnace oil again in heating and other places. We have seen another potentially a push for more renewables. There's a run on electrical cars here in Australia, so I think that's an implication, a direct impact of oil prices going up. And I think that people are going to reassess whether they should be putting that much trust into parts of the world which have difficult strategic neighborhoods, I guess. By the Qataris to potentially dominating and increasing their capacity from 77 million tons to 150 million tons out of a potential of a 600. A quarter of the world will be coming out of Qatar, add another 20, 30 million tons coming out of the Abu Dhabi, and you start realizing that we have 30% of the world's coming through of LNG of the world coming through the straits, and that's potentially quite risky. I think people are realizing that and looking at different options. However, as I've said many times in the past, there's just not a lot of options out there. Putting the US aside, you have a few projects going on in Canada. It's a big boost for the Canadian projects, potentially a boost for Alaskan projects, we'll see. And a boost for Argentinian projects. But other than that, I don't really see a lot of new supply, incremental supply coming from anywhere. Australia is in a world of hurt. We have very anti-LNG, anti-gas export policies in place. We have projects such as ICTIS, which are going on strike with the workers demanding $500,000 wages and fly in, fly out benefits to anywhere in the world. So that's completely ridiculous as well, in my view. So Australia is not going to see a lot of new investment. Projects such as in Abadi in Indonesia, maybe Timor down the road, they're going to be focused on very much regional. Indonesia has pretty much said that it wants LNG to be used domestically more than exports. So we're not going to see the world markets really benefit from any future Indonesian supply. Mozambique is still in a state, a precarious state. The other West African projects are fairly small to make a difference. So we're really, and then Russia, I think Russia is looking good right now. There's obviously talk within Europe that we should be nicer to Russia and allow them to export gas again. I have a feeling that as soon as this war ends, people are going to realize that Russia caused a lot of trouble, and they're not going to really open the gates for Russia that easily. So really, the incremental supply of the world has to come from the US. And as I said many times, there's just not a lot of new projects in the US. There's a lot of expansions going on right now. And anybody with gas that can sell right now is obviously benefiting a great deal. So that's kind of what I'm saying about the war. I think that it remains to be seen what the long-term demand destruction is. I think it's a fairly short-term thing. There's a lot of people around the world that have made a lot of import infrastructure investments that are dependent on LNG. And so they will be looking for LNG just to pay off that investment. And also, there's just not a lot of the choices. All the easy renewables are done, and there's more difficult, more tough economic projects to do around the world. But at the end of the day, I think the people that are using LNG are still going to want LNG. And as soon as the war is over, and hopefully the prices come back down to a reasonable level, they will continue importing. So I don't see that long-term demand destruction. However, I do see the long-term confidence destruction, and people may be as a bit more reluctant to sign Qatari contracts or Abu Dhabi contracts, especially if they don't offer the flexibility. In the past, the Qataris and Abu Dhabi, I guess, have been known to not offer any flexibility at all. There was no volume flexibility. There was no seasonal flexibility. There was no destination flexibility. It was take it or leave it. This was, the Louis Vuitton of LNG. And if you don't like it, you can go somewhere else. But if you need to ask a lot of questions, you don't belong in that store. Well, I think those days are over. That confidence is going to have to be regained, re-earned. And I think the Qataris and the Abu Dhabis are going to offer discounts and offer all kinds of things to get people back out there. Very similar to what we see in the airline industry. I live in Australia. It was always one of the most expensive was to fly Emirates and Etihad to Europe, and the Chinese airlines were the cheapest. And now suddenly, because I think people are not booking on these Middle Eastern airlines, they've dropped their fares dramatically, and the Chinese airlines are now the more expensive ones. So I think that they will have to do what they have to do to continue, growing their projects and selling their gas, but they will lose some of that hubris that they had in the past, and I think they'll come back down to earth a little bit. We've seen a lot of events. But I guess I can say honestly, most events that I go to, most conferences, Qatar doesn't show up. Abu Dhabi doesn't show up. They don't think it's necessary for them to do it. The market will come to them. I don't think that's the case anymore. I think they'll have to work a bit harder to get the market because the market has been burned. They declared force majeure very quickly. And if they extend that force majeure, they're leaving their customers out with a huge amount of exposure to buy gas when around the world it's very hard to buy gas right now. So that's my view. But the main topic of today's video is really about prices. What this war has shown to me, and I hope to show to a lot of people, is that it makes no sense now to continue linking oil and gas prices. This is something that the Middle East guys promoted, as well as Australia and Indonesia and others. But we really need to rethink that link today. We're in a situation where oil is roughly $100 around the world because obviously it's constrained, supply constrained, et cetera, et cetera. It makes a lot of sense. But gas price is not the same around the world. We still have $3, or it's actually $2.65 in the US today, and $14 in Europe, and about $16 in Asia. That is a disconnect. The European prices have actually come down from their peak when they were almost $20, but oil has not come down. So that is proving to us that there is a disconnect in the markets. They're no longer the same market. So why are we still pricing one according to the other? Let's just do some quick math here. A Henry Hub at $2.65 should imply oil at 6 times that price, around $20, less than 20, around $18. Oil, even in the US, is about, $95. So oil is selling at 6 times more than it should if the prices were linked. So around the world, today, the link makes sense. It's $15 gas, $190 to $100 oil, 6-to-1 ratio. Okay, it makes sense. But remember, a few weeks ago, right before the war started, we had gas at $8 in Europe, and oil was at $60 to $70. So that disconnect, it really didn't make sense at that time. The point is there should be no connection. We are now at a stage that we've been producing LNG for 30, 40 years. 50, 60 countries in the world import or export LNG. And we're still linking LNG to oil because we think it's something special. It has its own supply-demand dynamics. For instance, once the war finally ends, there's going to be less supply coming out of Qatar. We know that. It may take 3, 4, 5 years, whatever, to fix that. And the expansion projects in Qatar and the new projects in Abu Dhabi are probably going to be delayed. That should be reflected in the LNG market price. Oil, they may be able to recover that fairly quickly. There's extra capacity in the US. Oil prices could come down dramatically right after the war, back to the $60 level or $70 level. They can fix the oil facilities pretty quickly. And there's a lot of other places such as the US that will make up capacity as fast as they can, make up volume. So if you're still linking oil and gas, but the gas price has to reflect gas demand, supply, and the supply is going to be hampered for many more years, why are we still linking the two things? Now let's talk a little bit about what today's prices mean for the implied profits of these companies. And let's use the US as an example because the formula is actually quite simple. The US formula is the price of gas that you buy, which is Henry Hub or whatever the hub happens to be, pipeline that to your facility, the liquefaction fee, which is related to the capex of the facility, which integrates into that sometimes the energy cost of running those refrigerators, and the shipping cost to the market, such as Europe. At a 15 or 14.58 TTF European price, and I use $2 as shipping and $1 as pipeline, and the 265, which is the true Henry Hub price today, that implies that the liquefaction facilities are making almost $9. That's a lot. Now, are they making that $9? No, because a lot of these deals were signed as long-term 25-year-old deals, and they were signed at $2 liquefaction. So the liquefaction guy is not getting the benefit of the high prices. It's the importer, the guy who signed the 25-year deals. They could potentially making a $7 margin more than they did before because the gas price in Europe has gone up so much. Now, that is fine. They took a risk, they signed the long-term deal, and that's the way it is. My issue is coming up with the fact that today's capex is a lot higher than yesterday's capex. I know for a fact that some of the new LNG projects in the US, the capex is going to be 2 to 3 times, 2 to 300% higher than it was 5 years ago. But a lot of the buyers of the world are still stuck on this $2 or $2.50 tolling fee. If you had a $2 or $2.50 tolling fee, then that would imply that the price of the gas in Europe should be like $9 or $8. Well, it's a lot higher than that. But most importantly, the new projects cannot build their facilities with a $2 tolling fee. If the capex has gone up, the $2 tolling fee implies $500 a ton. Today's dollar per ton, $1,500 to $2,000 a ton. If you have a project finance project, like most of the projects in the US are, they cannot pay back their loan if they're only generating a $2 tolling fee when the capex is now $1,500 to $2,000 a ton. So something has to give. And this is why we see many projects stuck at FID in the States, even in today's market, is because there's a disconnect between what the buyers are willing to pay, which is they're still stuck on the $2 tolling fee, and what the producers have to charge because their capex has gone up. Why has the capex gone up? Because inflation everywhere is crazy, steel prices are high, energy prices are high, labor is overheated, there's not enough labor, young people don't want to become welders, there's only so many 50-year-old welders out there building all these LNG plants, and there's a potential tariff issue as well. As I made a case a few minutes ago, the US is where we have to make up the shortfall from the Middle East. There's not a lot of other choices, a little bit in Canada, maybe a little bit in East Africa, but not going to change the needle. The US has to be the bulk of that. And the bulk of that new LNG in the US is going to cost a lot more to make. Not because the Henry Hub price, the feed gas price is higher. It could go a little bit, but right now it's still pretty low. But it's because the facilities cost a lot more to build. So something has to give. The more realistic tolling fee today is well over $3.50, maybe close to $4. Venture Global did their earnings release last week. I encourage you to look at some of the articles written about it. They implied a tolling fee of $3.80. Now remember, this is the same Venture Global that was promising their long-term deals at $2 and below 4 or 5 years ago. So they are almost double the tolling fee. So how are they making ends work? Because they're making money up on the spot market. So they're taking a loss with their long-term buyers and making up on the spot market. The problem is new projects come along, and the new buyers, the new long-term buyers have to pay for the new capex. Otherwise, you don't get project finance. And the buyers I'm talking to, including a call I had this week, they're still stuck on the $2 level. So we have to see a disconnect. So I would like to see two disconnects. One is the disconnect between oil and gas prices. They're completely different markets. They should be completely different things. And one is now a disconnect between what LNG used to cost and what it truly will cost. Even from the Middle East right now, as soon as the war is over, Qatar is going to have to pay for all these repairs. Now, it's going to try to offer some discounts to keep some people happy, etc., and hope it makes up in the spot market. But I have a feeling that we are never going to see the 10% slope to Brent anymore, 10 or 12 or 13. It's going to be more like $15, 15% Brent slope, because there's $20 billion to pay for repairs. And the new stuff is going to cost a lot more because everybody's going to be overheated. And I think the risk premium to work in Qatar has just gone up. So my message to LNG buyers is that you've had a good run. You've enjoyed very cheap LNG for a long, long time. This war is going to reset two ways. We're going to see a less of a link between oil and gas because the markets are now completely different. And we're going to have to see a repricing of LNG to something of more realistic levels. Is TTF at 15 correct? I think it's more correct than TTF at 8. Where did it long-term stabilize to? Maybe 12. I don't know. But it's going to be something like that. Hope that's interesting. An announcement to make is I have actually developed a very, very comprehensive gas unit converter. The app versions are coming out soon, but the web version is already out. It's on the Gulfstream LNG/gas unit page. Go to gulfstreamlng.com, look at gas units, the tab, and start playing with the conversion calculator. It converts about 95 units, including price units and every volume unit, and including rate unit. So it can go from million of cubic feet per day to tons per year. It can go from dollars per megawatts to dollars per cubic foot to dollars per ton. It can go from millions of cubic feet to billions of cubic meters. It can do everything. I encourage you to go to the website and play with it. The app version is coming out soon, and it will be totally free as well. I'm hoping the app version comes out in the next few weeks. Okay, thank you. Hope that was fun.